What is a stock exchange? A stock exchange is a regulated marketplace where securities like stocks, bonds, and commodities are bought and sold. It provides a platform for companies to raise money by selling shares to the public, and for investors to buy and sell these shares. By listing shares on the exchange, companies can raise capital through a process called an initial public offering, IPO. The stock exchange ensures transparency, fairness, and liquidity, meaning that investors can buy or sell shares easily and at fair prices. Supply and demand determine stock prices, which fluctuate based on factors like company performance, economic news, and investor sentiment. There are two main types of exchanges: physical exchanges, like the New York Stock Exchange, NYSE, where trading once took place on a physical trading floor. Electronic exchanges, like NASDAQ, where trading is done digitally. Stock exchanges are highly regulated by government agencies or independent bodies, such as the Securities and Exchange Commission, SEC, in the U.S. This regulation ensures that trading is done in a secure and transparent way, protecting both companies and investors. Exchanges also provide indices that track the performance of specific groups of stocks, offering a snapshot of the market's overall health. Examples include the S&P 500 and Dow Jones Industrial Average in the U.S. In summary, a stock exchange connects companies with investors, facilitating the exchange of securities while ensuring that the market remains fair, transparent, and efficient. What are stocks? Stocks represent a share of ownership in a company. When you buy a stock, you become a shareholder, which means you own a part of the company's assets and profits. Companies issue stocks to raise money for growth, and in return, investors gain a stake in the business. Types of stocks. Common stocks. These give you voting rights in company decisions and the potential to earn dividends, a share of the company's profits. You can also benefit from capital appreciation if the stock's price rises. However, common shareholders are last in line to receive assets if the company goes bankrupt. Preferred stocks. These often don't provide voting rights, but offer fixed dividends that are paid before common stockholders receive anything. Preferred shareholders also have higher priority in case the company is liquidated, but they usually don't see as much price appreciation as common stocks. Why do people buy stocks? Investors buy stocks primarily for capital gains, buying at a low price and selling at a higher one, and dividends. Some stocks offer regular income through dividends, while others are seen as long-term investments that could grow in value over time. How are stock prices determined? Stock prices are driven by supply and demand. If more people want to buy a stock, high demand, its price goes up. If more people want to sell, high supply, the price goes down. Factors like a company's performance, market sentiment, and broader economic trends influence stock prices. Risks of owning stocks. Stocks can be volatile. Their prices can fluctuate widely, sometimes resulting in losses. There are no guaranteed returns, and if the company performs poorly, shareholders may not receive dividends or see any price growth. Common shareholders are also the last to be compensated if the company goes bankrupt. Diversification. Investors reduce risk by diversifying their portfolios, meaning they spread investments across different stocks, sectors, or asset types. This helps protect against large losses if one investment performs poorly. Conclusion: stocks are a way to own part of a company and potentially earn returns through price appreciation and dividends. While they carry risks, careful investing and diversification can help manage those risks and create long-term growth opportunities. How does the stock exchange work? Supply and demand. Stock prices on the exchange are determined by supply and demand. If a stock is in high demand, its price increases. If there are more sellers than buyers, supply exceeds demand, the price decreases. Trading hours. Most exchanges have specific trading hours during which you can buy and sell stocks. Brokers and online platforms. To trade on the stock exchange, you need a broker or use an online platform. Brokers connect buyers and sellers and execute your trading orders. Trading orders. If you want to buy or sell stocks, you place an order. There are different types of orders, such as a market order, buy or sell at the current price, or a limit order, buy-sell when the price reaches a specific level. Why do people invest in the stock market? Appreciation. People invest in stocks expecting that their value will increase, allowing them to sell at a higher price. Dividends. Some companies distribute a portion of their profits in the form of dividends, which can be another way to earn money. Diversification. Investing in stocks of different companies or sectors can reduce risk, as a drop in one stock's price can be offset by the rise of another. Risks associated with stock market trading. Volatility. Stock prices can fluctuate rapidly due to various factors such as economic news, political events, or company performance. Risk of loss. There is no guarantee that investing in stocks will always be profitable. Stock prices can drop, and you can lose part or even all of your investment. These are the basics of how the stock market works. If you have any further questions or want to dive deeper, I'd be happy to help.